I'm going to focus on ROIC, return on invested capital, and more broadly speaking, a fundamental financial analysis. First, what do high ROICs tell us about a company? And second, how does that tie into M&A and the powerful deal drivers that Rob just spoke about? As the saying goes, there's no better place to start than at the beginning. So at the most basic level, there are two types of money managers, right? There are traders who focus on short-term market dislocations, and there are investors who look for long-term cash flow generators, value opportunities, and compound returns. Now, many professional managers and individual investors would consider this obvious and not terribly useful. But if you ask them which of the two they are, and then you watch what they do over extended periods of time, you will notice that most of them exhibit the same fatal flaw, which is this. They think they are investors, but they behave like traders. This may sound trivial, but it is absolutely catastrophic. It is the single most important reason that most managers consistently underperform their benchmarks. They base their decisions on long-term factors, but what they end up doing is repeatedly reversing course and chasing the market over and over, almost always buying near peaks and selling near bottoms. And the result is always the same. The returns are stripped away through trading costs and by eating market spreads. Now guess what? True traders love this. Why? Simple. In a zero-sum game, in order to make money, you need a counterparty. That's it. It's just like poker. If you can't spot the sucker at the table, then you're probably it. All right, so if you know that, then what do? Well, you pick what you want to be, and you get really good at it. Or as Andrew Carnegie said, you put your eggs in one basket, and you watch the hell out of that basket. For us, the decision is a no-brainer because the science behind evaluating a business, to us at least, is much more rational and much more predictable than the psychology behind attempting to understand market fluctuations. Market patterns and charts are descriptive. They are not predictive. They tell you what has already happened, not what is going to happen, period. As one of the few investors who actually behaves like an investor, we approach investing from a fundamental perspective. We base our methods on finding businesses to own rather than stocks to trade. What we do is not rocket science, but I will tell you this, it is very difficult to adhere to consistently. And even more importantly, it is incredibly difficult to separate noise from information when you evaluate yourself, which you have to do in order to adapt and refine your processes. And that is key. You can't change what you do every year just because something new is in vogue or out of favor, especially because markets do exhibit mean reversion, but you do need to be able to recognize when one of your tools is actually broken. So about 3 years ago, I was watching an interview with a man named Charlie Munger. Now at the time, I did not know who he was, and that may sound scary for someone who's a professional money manager, but this will come as little surprise to people who know me well, as I have often been described, endearingly I hope, as a nonconformist and someone who stubbornly prefers to learn everything I can from the ground up, rather than to watch what other people are doing. So in the event that I'm not the only person in the room who is unaware, Charlie Munger is the vice chairman of Berkshire Hathaway and has served as Warren Buffett's right-hand man, or as Warren likes to say, his partner, for nearly 40 years. Immediately as I listened to the interview, I thought, wow, this is the first quote-unquote market pundit I've ever heard that thinks almost exactly the same way we do. In particular, he talked about the importance of a company's return on capital and how much more influential it is compared to the firm's valuation or the price you pay for a stock. His quote was, "It is far better to buy a wonderful company at a fair price than a fair company at a wonderful price." And he went on and expanded on this by explaining how even dramatically overpaying or underpaying for a stock is wiped out over a 10-plus year time frame and dominated by the earning ability of the company's underlying operations. Organic growth, as Rob mentioned. Even a very extreme example shows how powerful this force of compounding capital returns is. The little gray bar in the bottom of the screen, consider this. You buy two stocks, one at a 50% premium and one at a 50% discount to what they're actually worth. The expensive company generates ROCs of 15%, while the cheap company generates ROCs of 4%, which is about average nominal GDP growth over the last 2 decades. After 20 years, the gain on the expensive company is over 550% greater than the gain on the cheap company. And think about the magnitude of that. You're talking about buying a company at half price, which means that you've baked in on day one that you will double your money. And yet it still loses by over 4 times, or almost $500,000 on an initial trade of $100,000. Now the obvious question that I'm sure follows is, and I'll use Charlie's words, well, how about buying a wonderful company at a wonderful price? Best of both worlds, right? Well, there are times when this is actually possible, but they are far from pleasant. But then again, in order to get above average returns, you have to do what the average person is not doing. So let's talk about the unpleasant. The 2008 financial crisis. I would say the absolute scariest time to invest in almost any asset class, and yet it will undoubtedly go down as the single greatest buying opportunity that any of us have ever seen in our lifetimes. A financial crisis creates dream investments for the following reason. Investors big and small deleverage at the same time. And what does that do? It drives up asset correlations and it creates enormous risk premiums. Now, risk premiums are good. Let me repeat that. Risk premiums are in fact good things because they are reflected as discount rates in a stock's valuation, and they are inversely correlated to a stock's price. So let me simplify. The more fear there is in the market, the bigger the risk premiums. The bigger the risk premium, the bigger the discount rate. The bigger the discount rate, the cheaper the stock. And risk premiums come in 2 forms. First is market-specific or systematic risk, and the second is company-specific or idiosyncratic risk. Now, abnormal market risk premiums are a gift. Why? Because it means that individual stocks are being sold indiscriminately at low prices, regardless of how strong or how weak they are. And this is the result of broad-based selling or liquidating. You can think of it as throwing out the baby with the bathwater. Now, in extreme scenarios such as late 2008 and early 2009, you can actually see something quite remarkable. You can see higher quality companies being discounted and selling off even more than lower quality companies. Why on earth would that occur? Well, the reason that occurs is something called forced selling. What happens is that leading into the top of the market, and the last cycle in particular, right before the worst of it, the big institutional investors and hedge funds were doing the same thing. They were using massive leverage in a low volatility world and all plowed into the same high growth companies. Everything keeps getting bid up and the returns look fantastic. Easy game, right? Well, that is until the credit markets froze and lenders wanted their margin back. Now they all had to scramble to liquidate those same positions so that they could meet daily margin calls. Now they knew, and trust me, the smart ones knew, that they were giving away these companies at pennies on the dollar, but there was absolutely nothing that any of them could do about it. And if you happen to be an unlevered manager with cash on hand, it was a fascinating time to be a market participant. And a little footnote here. So all those funds that were using leverage to generate supposed alpha is if you simply looked through and measured their return on invested capital and not their return on equity, you saw that their performance was actually quite abysmal. So ROIC, tying back to the subject of this presentation, is not just useful for company analysis, it has applications everywhere. And it's just logical, right? Even intangibly. What are you able to do with what you've been given? ROIC. Furthermore, I'll tell you, every single intern we've ever had and every family friend who's asked for college advice or a letter of recommendation, I always make sure to tell them one thing. Whatever you choose to major in, take at least one course in advanced logic. It doesn't matter which department, math, computer science, electrical engineering, even philosophy. Well, as long as there's some math in it. Just take at least one class and it will benefit you immensely in whatever field you enter, which is how we as a company have gotten to where we are. If you follow logic and sound judgment rather than emotion or the most appealing story, you will, much more often than not, generate a good result. And while all of this sounds great in theory, it still needs to be made actionable. Theory is no good unless it can be bridged to application. That is the main reason that I prefer math-based logic to philosophy-based logic. Both are great conceptually, but it's math that helps you apply the theory. So how do you do that? Well, for us, we created a financial model and an analytical tool that we call AdStar. The genesis for AdStar started back in early 2009. We looked around and we knew that there were diamonds in the rough. There were many companies that would suffer and go under, but there were also others that would grow stronger and expand into new industries. The problem was that we didn't have a way to rapidly and reliably identify these companies and sort the good from the bad. So we started at the best place, with logic. We asked ourselves, what kind of things would we want to know if we were considering buying a business? What questions would we ask the current owner, and then what would we do with that information? Next we said, okay, of those questions, which have answers that can be quantified and which don't? For the ones that don't, where do we have to look to find those answers and clues? And usually, you end up somewhere in annual reports and company filings. But for the answers that are quantifiable, well, how do you represent them mathematically? And that was the birth of this model that we develop and use to this day to find great companies. If you look at this slide, you can see some of the general categories of information that AdStar can instantly tell us about any company that we plug in. If I were to go into the details of every function and underlying financial metric, it would be incredibly dry. I've done it once before, so I can speak from experience, and it would take a very long time. And because I'm wiser now, I'm not cruel, and because the wet bar is not yet open, what I'll do instead is I'll run through a live example at the end of this, and I'll highlight some of the basics. As they say, the proof is in the pudding. And over time, AdStar has demonstrated its effectiveness and proved its worth evident in the long-term returns of our various portfolios. Now, embedded within that strong performance is a very interesting trend that we uncovered a few years ago. We noticed that an abnormally high number of our companies would get bought out by larger corporations. But because we often sell on the announcement of the offer, not many of our clients even know how much M&A activity actually occurs inside their accounts. The reason that we generally sell in the news is that the stock many times will spike above the deal price because short sellers have to cover their positions and because day traders like to come in, spin the wheel in hopes of a bidding war, which rarely happens. So we decided to go back and look at the deals that have occurred in our portfolios. The table on this slide lists the companies that we held that were either bought or extended an offer. And the deals highlighted in green represent the ones that have occurred in the last 6 months. During this time, we've had 10 companies, all mid-cap, which tends to be the sweet spot, acquired. The average premium for these deals was a 32% increase from the prior day's close. Okay, so then why does AdStar seem to consistently identify attractive targets? To put it simply, probably because at its core, AdStar asks the same type of questions that CEOs and CEOs of big multinationals ask smarter minds, like Rob Kindler, when they begin the process of evaluating buyout candidates. To be more specific, they want to know, is this a company that will create value for us on a risk-adjusted basis over the long haul, i.e. cash flow return on invested capital? Now, there are other types of deals. Some involve vertical integration, diversification, economies of scale, etc. But the bulk of the deals, especially in the small and mid-cap space, are vetted from a capital budgeting and internal rate of return perspective. Looking at a firm's ROIC does two things. First, it makes the CFO sleep well at night because he knows that the deal is NPV positive and will out-earn the cost of financing it. But secondly, and much more abstractly, it tells you big picture things about the firm. Important big picture things, like how attractive in the long term is a firm and the industry that it operates in. Some of you may be familiar with what are called Porter's 5 forces, and others of you have probably heard of economic moats, a term that Warren Buffett coined. But in essence, they're all related to the same thing: a company's competitive advantages and their competitive threats. Now, these characteristics are much more qualitative in nature, but there are certain financial metrics and ratios that we can look at that will lead us towards attractive firms and away from firms that will likely stagnate or are in danger of becoming obsolete. And one of those metrics is definitely return on capital. Another common question that ties this whole presentation together is, why are large companies willing to pay such substantial premiums for high growth businesses? Well, certainly things like cost synergies and cross-selling create value, but the main reason is what Charlie Munger said: buying great companies at even an expensive price is much better than buying average companies at cheap prices. Look no further than Berkshire Hathaway's recent buyout of Kraft. Now, we actually own Kraft in our high dividend portfolio, and we held it for just under 2 years, made 40%. We sold the company in January when the dividend yield fell below 3.5. We still love the company, But unlike our high growth portfolio, the high dividend strategy has a requirement that prevents us from holding companies at low yields. So what is Berkshire paying for Kraft? Well, it's a 28% premium above where we sold it, and it's 37% above the closing price before the announcement. Buffett knows that this premium is minuscule compared to the cash flows that Kraft will generate for the next 30 years. This slide shows another perfect example. Let's go back to March 2009. We had just built AdStar and started hunting for those diamonds in the rough. One of them was a company called Omniture. Actually, a really fantastic business with superior technology. What they do is they produce software that performs behavioral targeting. Behavioral targeting is quite fascinating. Basically, what that does is it is an application that's used by any company that does online or email marketing in order to monitor and measure the effectiveness of displayed content, and then to dynamically alter or customize that content based on a user-specific profile. In layman's terms, when you or your son or daughter in college visit a website such as Amazon, the images and promotions that you see are different than the ones that your daughter or son sees. And in fact, the prices offered to you for the same exact product can be meaningfully different. And this has actually caused some controversy, but hasn't received nearly as much media attention as I would have expected. Mostly, I guess, because it's not illegal. It's just something called price discrimination, which is sort of a microeconomic nirvana and something that has recently helped airline profitability immensely. Okay, so Adobe buys Omniture and we make 24% in one day. Good result? Yes and no. Yes, because it contributed nicely to our performance for that month, but also no, because I remember clear as day walking over to Mark's office, he probably remembers this, and saying, "This sucks." He knew exactly what I meant. We knew that this company was light years ahead of its nearest competitor and dominated the market for online advertising, which at the time was really just beginning to take off. And if you look at this slide, you'll see a few other companies that we bought at almost the exact same time as Omniture, that were lucky enough, or maybe smart enough, to avoid being taken over. F5 Networks, C-Chirp, Akamai, all up 500, 400%. And 500% on your money over 5 years is definitely better than a quick 30% pop. And that's why we continue to be investors and not traders, and why we place tremendous value on finding great companies. Now I'm going to run through a live demo of AdStar, assuming technology agrees with me today. We'll start with a company called Garmin. Some of you may be familiar. And then afterwards, I'll take a shout out, or I'll just run through an example that Mark throws at me, just in the event that anybody has a particular company they're interested in. Okay, Garmin. They primarily manufacture GPS navigational devices, one of which I actually use and have mounted in the dash of my car right now. So we'll take a look at the financials of Garmin and how they've performed, at least as a business, over the past several years. The first section here, again, this is going to be sort of incredibly difficult to follow. If you look at the left-hand side, these are all descriptors of the company. Market cap, number of employees, free float, and the item directly across from it is the value of that metric. So Garmin is about a $9 billion company. It's based in Switzerland. I actually didn't know that. I'm not very familiar with this stock. I just printed this out last night, but we will go down and I'll flip around here, but I'm going to go to the first section that I go to when I'm looking at any company. It's return on capital, and I'm comparing that to its cost of capital in order to determine is this company investable or not. If it out-earns its cost of capital, it's investable, and we can go in and dig deeper and look at it. If it doesn't, then no matter how compelling the story, how great the new leadership they brought in to turn it around, we simply will not invest in it because we don't believe that there's a high degree of probability in determining whether that company will be successful in turning around. So its weighted average cost of capital is 9%. Cost of equity is obviously, no surprise, roughly 9%. Cost of debt is very low. It may not have any debt, but here we go. So the CFROC, cash flow return on capital, is just this past year, fiscal 2014, 10.3%. It's above its cost of capital. And in fact, if you ever line beneath it is the year back, so 2014, 13, 12, 11, 10. So at a basic level, this company to us is investable, but because it's out earning its cost of capital. But if you look at the trend, it's actually quite alarming. 42%, 25, 23.5, 23.6, 17, 14, and 10. So it's very quickly converging to its cost of capital. And so that would definitely lead us away from investing in this company. And again, it doesn't mean that this company can't turn it around and it can't begin to generate higher ROCs in the future. But for us, again, it's all about having a high degree of probability in what we invest in. We're not trying to bat 1,000, we're trying to bet about 750. And because of the trend that Garmin is dealing with, we wouldn't avoid this company. But we can look at a couple other metrics just to give you an idea of the things we're looking at. So let's come down to another fairly important one, is right here, dividend yield. Okay, so it does pay a dividend, which makes sense because I don't think a lot of people would want to invest in this company if it wasn't paying you back something. It's 4.5%. Which is a pretty decent dividend, but the first and most important thing you want to do after you've looked at the yield is to go back and look at the coverage ratios. Is the company generating from its organic operations enough cash flow on a recurring basis to cover that dividend and hopefully have some left over to reinvest for future growth? So we'll answer that question in a minute here. But if you look at revenue growth over the past 6 years, it's pretty choppy. They recovered this past year, and they had a 10% increase in revenue growth. You can see right here. So that's 2014 is 10.3, and all the numbers below it. The prior 2 years, -3%, -2%. They were contracting. They had 1 year before that in 2012 where they were up. So it's been a rocky ride, and again, definitely not a company that we will consider, would consider for any of our portfolios. But to answer the dividend coverage question, they also are buying back shares, but that is beginning to slow. So let's see, dividend coverage. And again, when we're looking at dividend coverage, when we're looking at growth, when we're looking at valuation, we tend to more or less not ignore entirely, but we don't look at the common things: PE, earnings, EPS, net income. Those things are accounting-based metrics, and they're subject to different kinds of estimates and can more easily be skewed than if you look at cash accounting, cash that's coming in and out of the door. So sort of everything we do is kind of based on figuring out what cash flow is the firm generating on a recurring basis, and what's the maximum amount of cash that the firm's business, its core business, generates in a year that it could pay out if it wanted to. So a firm could pay out a special dividend. What's that amount that a firm could pay out and not disrupt or hurt its current operations and growth trajectory? And that's what we consider free cash flow. Now the market definition of free cash flow, which is cash flow from operations subtracting out CapEx, is also, for us, we believe misleading, because if you're looking at small companies that are growing, they're going to be running negative free cash flow for years and years and years. Omniture is a great example. That had, I believe that had negative free cash flow if you look at it in the traditional way free cash flow is generated, only because a lot of their CapEx that was being spent and causing that number to look negative and red and scary, a lot of that CapEx that was being spent was for future growth opportunities, not to maintain their current stream of cash, and would be rewarded if you understood that and invested in the stock. So dividend payout ratio, okay, again, sort of makes sense. It's a bit of an alarming trend. So let's bring this up. So if you look at dividend payout ratio 4 years ago, it's paying out 14% of its cash. That's great, because it's depending on what the yield was in that year, it's only paying out a smaller portion of its cash flow from operations, and then it's having a lot to reinvest into the business, which was obviously a struggle for them at the time, because you had Google Maps, which sort of blew up onto the scene and sort of got plugged into every mobile device, and all of a sudden you have free navigation. Why do you buy Garmin when you have that? I did because I liked the product, it was good technology, but great companies do not always make great investments. So a great product is not the end of the search. You gotta keep digging. So again, 4 years ago it was paying out 14% of its cash, and then 3 years ago it's 40%, 2 years ago it's 50%, 1 year ago it's 61%, and last year it's up to 82%. So great, it's got a high yield, but it's paying out more and more of its cash. At a certain point, even if the company doesn't grow and doesn't get any worse, that number is going to start to get near 100, and at that level, the dividend will likely be no longer sustainable. So what that would lead me to say is I'm not going to bet on dividend growth at all, and in fact, I'd probably bet that the dividend at some point, barring a new innovation or some product they come out that saved their business, that dividend will not be sustainable in the long term. And that's important. You know, in 2009, we had a lot of investors and clients calling in and say, hey, there's this really interesting company. It's got a 19% yield. Should I buy it? And I said, well, I can't answer that question yet. I got to go and look and see, is that 19% yield sustainable? So that's always the first question you want to answer, when you see something with a high yield. And we'll just come down to this next section here. These are analyst revisions. So these are not what they're expecting the company to grow at over the next few years, but this is the revision to those estimates. So if you see a lot of red, then they're constantly, the company's constantly disappointing, and they're not meeting whatever target they've sort of set out for themselves at the beginning of the year or in prior quarterly calls. But we will get down to, so current year, expected revenue growth, 0.3%, pretty much nothing. EPS growth, which again is not as important to us, but there are times when you want to look at it because cash flow growth up 22% next year is the expectation, can be misleading because firms are doing things with inventory, so you want to kind of get down to what is its real economic profit going to grow at next year, and it looks like it's going to be slightly down. And then the following 2 years, which again, difficult to predict with any degree of confidence for any company, but especially a company like this that's been having a tough time. 2016, they're expecting slight top-line growth, 1.2%, EPS growth, 3%. It's hard to have too much faith in that, but again, those numbers would not satisfy us because they're not going on a risk-adjusted basis. So whenever we're looking at what is a firm expected to grow at, is a firm expected to grow at 10% and one is expected to grow at 8%, which is better? Well, there's a couple of what ifs and catches with that. The first is how much risk is the firm taking to generate that 10 or 8% growth. So you have to sort of risk adjust what you require, what you demand as an investor, a company to grow at in order to be compensated for the fact that you've given your capital to this company. So risk adjusting sort of every sort of growth hurdle and metric and demand that we place on companies when we look at their operating history in the past 5 years is incredibly important. Because all companies can grow and they can take lots of risk to do it. You want to make sure the companies on a risk-adjusted basis are really creating value for you. I'll go down to this last section and then I'll bring Bill back up to introduce our next speakers. This last section is kind of all valuation, and we strip it down to, again, this is PE. PE next year of 10, and again, as I said before, earnings per share, we're not as happy looking at. We like to calculate our own metric, so we have a price to free cash flow. 8.3 is better, but again, you're paying an 8-9 multiple for a company that is clearly stagnating, consolidating, not growing, and at a certain point may have to cut their dividend and possibly become obsolete or be sold off to a larger company.